Welcome to the third lecture of sixth week. In this lecture, we are going to discuss about monopoly, and we'll see whether that is more of a suited form for to understand the market structure which related to the markets in energy. So before this video, we have already discussed about perfect competition. We tried to understand the theory behind it. We also tried to understand what are the situations or what are the characteristics of the energy projects or energy market that makes it deviate from the perfectly competitive market structure. And towards the end, what we discussed is that does it mean that this lumpiness of investment, this high fixed cost, all of them are the indicative of the fact that monopoly is a better market form within which the energy market can be analyzed. So this is what we are going to look at in this video. But as the way in which we are doing it, initially we'll have a discussion about the theoretical understanding of what monopoly actually means. So this is the structure that we have been following. For this as well, you can consider chapter 12 and 13 from the same book that I referred to. So we discussed about perfect competition, and here we are going to discuss about monopoly. What is the crucial feature of monopoly and how does it deviate strongly from perfect competition? It lies here. This is again a repetition. We discussed that in case of monopoly, there are many buyers. However, there will be one single seller in the market. Now you see, if there is one single seller in the market and there are multiple buyers, then what essentially happens, the seller, who is the individual seller, it has some dominance in the market. It enjoys some market power. It can extract a higher price from the consumer. But that is not, indiscriminate higher price. There is a limit to it, and there is a theory behind it. How much higher price the monopoly can extract as compared to the perfectly competitive market. And this is what we are going to see in this video. What are the features of monopoly? Let us start with a couple of examples. Let us think about the pizza. So in US, on an average, the variable cost of making one medium-sized pizza is $1 to $2, and the price of the pizza is $7. So when I say that the variable cost of producing one medium pizza, you can also think about it as the marginal cost of producing one pizza, right? What does this include? What does this cost include? This will eventually include, the cost of the flour, the cost of the cheese, the cost of other ingredients, the payment to the labor, the electricity bill that you are, probably paying to run the facility, and so on. What will it not include? It will not include the oven, for example, or the other facility that are installed in the whole infrastructure. I mean, the whole infrastructure will not be the cost of the infrastructure itself, which needs to be installed at the beginning of the production, will be the fixed cost and will not be incorporated in the average cost or in the marginal cost or in the average variable cost, right? So if you look at the average variable cost or if you look at the marginal cost is relatively smaller, right? So if under perfect competitive market, if the producer has to equate the market price with the marginal cost, then the cost of pizza would have been $1 to $2. However, it's much more than that. It's $7. Even the pizza company will not go out of the business if they start charging $10 from you. Why is it the case? The reason is that there are very limited options in front of you. So the number of producers or number of sellers of pizza are very limited in the market. Now this kind of behavior you cannot expect from a vegetable vendor who is running a shop in a market. So in the market, there are some 10-12 vegetable vendors, and they cannot charge you more than, one cannot charge more than the other, because then they know that the entire customer base will be shifted to the other supplier. So that was the characteristic of the perfectly competitive market. Here you see the price charged by the monopolist is actually higher than the marginal cost. So this is the first point of departure from the perfectly competitive market outcome. However, in future we will see that this does not mean that the monopolist is not actually maximizing profit. Let us take the second example. And this is the example that is known to all of us. This is in 1973, where the first oil crisis took place, and we all know the history of this oil crisis. And what happened, that the price of oil, it rose from, on an average, $2 per barrel to $12 per barrel globally. So that was the average global increase in the price of oil. Now, how could that happen? Is it the case that suddenly there was a change in the cost of production? Was it the case that there was a sudden increase in the marginal cost of production? Clearly, the answer was no. It was triggered by certain geopolitical situation, and the supplier of the oil, the major supplier of the oil in the world, they made a cartel and they made a decision. They are going to act together and reduce the supply of oil to a particular part of the world. So this kind of increase in price from $2 per barrel to $12 per barrel has nothing to do with the marginal cost of production. So here also you can see, essentially the producers are not equating the price with the marginal cost of production. Then if the marginal cost doesn't change, the price is not going to change at all. And in the very first place, they would not have any power to change the price, okay? Because the perfectly competitive markets are price takers. But clearly, in case of oil, what you can observe is that there are not many sellers of oil, whereas there are multiple n number of buyers of oil. So there are limited number of suppliers and there are many buyers in the market. Now, when you actually look at the practical examples with respect to monopoly, you will understand that monopoly is actually a theoretical extreme that we discussed, with one seller and multiple number of buyers. In reality, what you see, there are limited number of sellers, but there are multiple number of buyers. We call this market structure oligopoly. However, it's very important to understand the features of monopoly, because that actually deviates from the feature of oligopoly. Sometimes, even though there are some limited number of firms in the market, they follow the behavior of monopolistic firms rather than the oligopolistic firms. This also holds, this charging the price which is much higher than the marginal cost in case of any copyrighted item. Suppose you want to buy some kind of a software, right? So the price that is charged to you, this is not really the marginal cost of supplying that software to you. So nowadays the marginal cost of supplying a software will be very limited. It will be the cost of a pen drive, or it will be just a cost of a CD, or sometimes it's just shared over the link. So giving the access to a particular software to one more individual doesn't actually provoke a lot of cost. So the marginal cost is not high. However, since there is a copyright, the producer or the supplier, being the one of the limited number of producers or suppliers, actually can deviate from this price equal to marginal cost kind of equilibrium. So what we see clearly, that if there are limited number of producers, they have some kind of a power so that they charge the price which is higher than the marginal cost. The question that arises, that we have seen in case of perfectly competitive market structure, that the maximization of profit takes place if price is equated to marginal cost. So is it the case that monopolists are actually deviating from a perfectly competitive market structure by charging, is it the case that the monopolists are actually deviating from the profit maximization by charging a price which is higher than the marginal cost? And the answer is no. We'll explore why it is happening. One more interesting observation. So far, whatever we have discussed, it seems that monopolists are the limited number of producers in the market. Therefore, they have certain market power, and as a result, they exert that market power in order to extract a price which is higher than the marginal cost. However, monopoly can also become a form of public ownership. So when the government owns something, that is a public monopoly. And in case of public monopoly, it may not be the case that the government is charging the price which is higher than the marginal cost. it becomes in this kind of a situation that the government knows that if it is given to the private hands, then there will be only one or limited number of producer and supplier in the market, and therefore they will exercise their power to increase the price over and above marginal cost. Okay, since they do not want the private entities to allow to do that, they own the they try to be the sole operator in the market. This thing happened in case of Coal India. So Coal India was a totally private enterprise till February 2018. After that, it was privatized. Indian Railway is another very important example where we see public monopoly. So state is the only producer and supplier of the railway services in India. However, if you look at the airline services, there are multiple number of suppliers, including state being one of the suppliers. And you will see that the economics of railways is very, very different from the economics of airlines. So the next question that we ask that, okay, we understand what the monopolist is going to do with the price by deviating from the marginal cost and charging a price which is higher than marginal cost. But the more interesting and fundamental question is what leads to monopoly, right? So what are the circumstances that actually lead to a monopoly kind of situation? So I have just mentioned two reasons here. One is the monopoly of resources, and the second is the case of a natural monopoly. So so basically, if you have monopoly over resources, that too may lead to a case of natural monopoly, but may not. So what is the monopoly of resources? Let us take a very interesting example, which is although unrelated with energy, but this is a very interesting example to understand the monopolistic behavior. This is the case of diamond industry. So diamond was first introduced in late 19th century by the Dutch brothers, who are the De Beers brothers, and who owned some farms in South Africa. So these farms were owned by these brothers, and they actually discovered some diamond in their field. Now, once it was discovered, people came to know that some very important and precious things have been discovered in this field, and therefore everybody wanted to buy that land. So this land, which was initially owned by the De Beers brothers, it were bought and sold. It changed the hand for a number of time. The British government at that point of time got involved to have access to that land as well. And finally, a British businessman bought this piece of land, and they started a mining company of diamond, which is called De Beers, in 1888. Now see, there was this sole piece of land and some peripheral land at that part of the world, which had the initial resource to start the business with. So no other part of the world, diamond was discovered. So when the De Beers was formed in 1888, so this British businessman, he was he has the only one who had access to the resource. So in this way, the access to resource, if only one person or one company has access to resource, then the monopoly automatically comes. And this monopoly of De Beers in the business of diamond, it actually continued for a long period of time. After, in late 20th century, that was abolished because there were certain, allegations against monopoly, and then the business strategy changed. And now you also get diamond in many parts of at least some parts of the world. Same kind of thing happens in kind of mining of non-renewable resources. For example, Coal India, where we said that this is a public enterprise. Now see, when we talk about mining is a very cost-intensive affair. Now, not everybody can invest in mining. Not everybody can, invest in oil field. It's a big affair. It's a, investment sensitive affair, and it has other characteristics as well, as we have discussed. This has asset specificity. So if the business falls, then you know very well that the asset that you have purchased, that is not going to be used in some other way. Okay. So there are a lot of risks that you have to take. Now, there are not many people, or there are not many business houses that can take this kind of risk. If that is the case, at the very initial stage, what you have a limited number of suppliers, limited number of willing producers who are entering into the market. And therefore, in future, only some of them will sustain. Those who succeed, they will sustain. And you, at the end of the day, you actually stay back with a very limited number of successful suppliers who have discovered the resources and who can economically actually extract the natural resources. Okay. So this again leads to a monopoly. Now, if the government wants to restrict the entry of the private enterprise in this kind of action, then the government can go for a public ownership. There is another reason why public ownership is actually important in this kind of energy resources. The reason is that, see, given this asset specificity, this high investment at the beginning, and huge gestation period, low rate of return at the initial phase, all these things actually discourages people from investing in energy projects. So in order to make it up, the government sometimes comes forward and takes the responsibility to invest in this energy related project. Therefore, that is why probably you see so many enterprises, the government, the production of electricity by government owned enterprises is still dominating in India. Maybe that is one of the reasons, because it's a very high risk involved investment. Although nowadays the situation has changed, you have seen a lot of deregularization, you have seen a lot of private entities coming along and supplying the power sector in the power sector as well. You experience the opening up the coal mines as well. So things are changing in a different direction nowadays. The second thing is a little more theoretical, although the genesis is very practical. This I quote from Baumel's writing in 1977, pretty old writing, but what he says is that industry in which multi-farm production is more costly than production by a monopoly. There you have a natural monopoly. So let me just explain things a bit. This actually happens when your fixed cost is very, very high. Now, if you remember the cost curve, what was happening? The average fixed cost curve it looked like a rectangular hyperbola, right? So it was declining throughout. The average variable cost, if you see, the average variable cost was initially declining, and then it looked like a U-shaped curve, and then it went up. Okay. So as long the average productivity of your variable input increases, your average variable cost declines. As soon the average productivity of your variable input starts declining, your variable cost will start increasing. And what was the average cost curve? The average cost curve was the vertical integration of the average fixed cost curve and average variable cost curve. Now, what we said that up to the point at which the average variable cost curve was declining, average cost curve will decline. Because up to that point, what is happening? Both average variable cost as well as average fixed cost is declining. After that, for a while, the average cost curve will decline because the influence of declining average fixed cost curve is more. After that, we saw that average cost curve is rising because the influence of rising average variable cost was greater on AC. So that is why we got a kind of structure of average variable cost and average cost and average fixed cost. Now the problem is that if you have an investment where the average fixed cost is very, very high and variable cost is quite low, in that case the entire cost structure is dominated by the average fixed cost. Now what happens if there is a dominance of average fixed cost? You see that the shape of the average cost curve was determined through the interaction between the shape of average fixed cost and average variable cost. Now, if average variable cost is too insignificant as compared to the average fixed cost, then the pattern of average fixed cost will also guide the pattern of average cost curve. So, in case of those industries where the average, the fixed cost itself is too high, because average fixed cost is totally falling, the average cost will also keep on falling. It will never rise. So this is the case where we call the case of a natural monopoly, where average cost curve is always declining. Now theoretically, it's always true, always, not only in this case, that if average declines, then the marginal has to be below the average. Let us take an example from a cricket match again. So what happens in this case? Suppose India has a falling run rate. So India is batting and it has a falling run rate, right? So after 10 overs, India has scored 60 runs. So 6 is the run rate. So the average cost, analogy of average cost is 6. Now what we are saying that the average cost is declining. So the average run scored by India has to decline. So it has to decline from 6 to say less than 6. So in order to make the average less than 6, in the 11th over, India has to score 5 runs. Okay, so the marginal is less than the existing average. So this is always true. This is a universal relationship between the average and marginal. So if average falls, then the marginal will always lie below the average. Okay. So in this kind of a situation where the industry has a very huge fixed cost, this is how the marginal cost and average cost curve look like. So both of them are falling. However, the marginal cost is always lower than the average cost. Now this is a case of natural monopoly. This is a case where we call it a case of natural monopoly. Why is it called natural monopoly? Because if you look at the curves here, as you keep on increasing the production, your cost will decline forever. So you have no incentive to stop your production. Whereas a new entrant, a new farm will have to start from a high price. So as you keep on increasing your production, your cost falls. So you are at this stage, whereas the new entrant will start from here. So this new entrant will stand nowhere in competition with respect to the existing farm. So therefore, everybody other than the existing farm will be driven out of the market from the competition as a supplier. So this is generally called as the natural monopoly. Now there are multiple examples of natural monopoly. One close example that you can say that in US till 1970 there was only one company who produced the aircrafts. That was the Boeing. So Boeing had the monopoly in the production of aircraft until 1970s. In 1970s, so until 1970s, so you have to make a huge investment initially in order to be able to manufacture the aircraft. Once you make that investment, the variable cost is insignificant as compared to that. Now, after 1970s, of course, it has changed. Now you have Airbus as well. So now they have engaged in more kind of an oligopolistic or duopolistic setup, but that's different. So what we try to imply at this point is that if you look at the characteristics of the monopoly, you will see that there is a close match between the characteristics that we have been discussing here with the energy projects. Because energy projects, again, you have sole access to resources, you have very high initial investment, your variable cost is relatively lower as compared to the fixed cost, and so on. So it gives us a glimpse that probably monopolistic market structure may be able to capture the energy market. However, the mathematics of monopolistic market structure is a little complicated as compared to the perfectly competitive market structure. So we'll go slowly and we'll try to understand where does the equilibrium take place. If you want to explore some of the basic economics books in order to understand this kind of market structures, one very good book that we always refer is the Intermediate Microeconomics by Holvarian. You can explore this book. This book is readily available in the market. Sometimes the soft copies are also available from the publisher, but I'm not very sure of that. So let us look at the equilibrium that you have in monopoly and how is there a deviation from the equilibrium that you had already obtained in the context of perfectly competitive market structure. So we start with the downward falling demand curve in case of the monopolies. So for the monopolies, this is similar to the perfect competition. This is nothing new. There is a downward falling demand curve. And this demand curve is represented as P is as a function of Q. So I should, yeah. So this is where we should plot P. Somehow it has disappeared. Yeah. So this is P. Here we are also plotting cost here. So if we look at this demand curve, this is the market demand curve, right? So this is the demand curve that the monopolist is facing. Now this demand curve is denoted by P equal to PQ. So P as a function of Q, P prime is negative. So as Q increases, P falls. This is true because this is a negatively sloped curve. Now, what does this demand curve capture? The demand curve actually captures the willingness to pay of the consumer. This is how we have not so far interpreted demand curve, but this is one of the very crucial interpretations of demand curve. Why does it capture the demand curve, the maximum willingness? Why does the demand curve capture the maximum willingness to pay of a consumer? See, you can interpret any point on demand curve in the following manner. What you can say is that if this is the quantity demanded, what is the maximum price that you are willing to pay? So if this is the demand curve, the consumer will say, okay, I'll be paying. So I'll go up to here, this point, and this is the amount of price I'm willing to pay at max. If you charge me a price which is more than this, then I'm not going to buy your product, right? So the demand curve also represents the maximum willingness to pay that the consumer has. However, you will realize that the price that was charged in a competitive market, that was actually not the highest willingness to pay of a consumer. That was actually lower than the highest willingness to pay from a consumer. But we'll not enter into that discussion. So if you ask the consumer pay at this point for this much of quantity, the consumer will probably say yes. That is what the demand curve says. Now, since there is only one firm in the market, it's not a price taker, right? It has some monopoly power, it has some market power, and therefore it can change the highest amount. It can, change the price from the competitive outcome, and it can charge the highest amount of money that the consumer is willing to pay for a particular level of output. So how does the mathematics go for the monopolist? See, for the monopolist will also try to maximize the profit. So profit maximization will always be at the heart of any producer, be it in a perfectly competitive market, be in a monopolistic market. But how does the total, and what is profit? Profit is equal to total revenue minus total cost. Now the question is, what is total revenue for a perfectly competitive market? For a monopolist. For the monopolist, the total revenue is price multiplied by Q. That is fine. But this price, as I said, that the monopolist can actually extract the highest willingness to pay of a consumer, this P is not fixed to the monopolist. So for a monopolist, unlike the perfectly competitive market, this P is a function of Q. So as Q changes, the monopolist can charge different amount of price from the consumers. It's not fixed by the market. The monopoly has this power. So this is the total revenue of the monopolist. If this is the total revenue, then you see what is the marginal revenue and what is the average revenue. Let us first deal with, so we know what is total revenue. Let us first deal with the average revenue. So if you look at average revenue, this is total revenue divided by Q. So this is equal to PQ. Now, if I plot average revenue here, so along with P, I am also going to plot average revenue here. If I plot average revenue here, what I will see is that AR is equal to PQ actually denotes the average revenue curve. And P is equal to PQ was denoting my demand curve. So essentially the average revenue curve and the demand curve are basically the same. There is no difference in that. So the line that I have drawn here, this represents both the average revenue curve as well as the demand curve. Right? So this is the price charged by the monopolist. Let us now come back to the marginal revenue curve. For marginal revenue, what we have to do, we have to take a derivative of total revenue with respect to Q. Now see, although the monopolist can choose or influence the price, because price is a function of quantity, the choice variable in front of the monopolist is also initially the quantity. Once the quantity is decided based on the demand curve, it can charge the price. But initially it's going to determine what is the quantity that is to be produced. So if I take the marginal revenue, that is the derivative of total revenue with respect to Q, what I get is PQ plus P prime Q multiplied by Q. How am I going to get this? Look at this function. So total revenue, this is the total revenue function. There are two components in this, PQ and Q. So when I'm taking the total derivative, in the first place, I'm keeping PQ constant and I'm taking a derivative of Q with respect to Q. So that is giving me this term. So this is I'm getting from the this is what I'm getting by keeping PQ constant and taking derivative of Q in terms of Q. Plus what I'm doing, plus in in the multiplicative rule, in this case I have to keep Q constant. So I keep the Q constant, I take the derivative of PQ with respect to Q. So that is giving me P prime Q. So in the second term in the multiplicative form, what we get is P prime Q multiplied by Q. So actually, so this is what I should get. So this is the marginal revenue. Now, if you look at the marginal revenue, it has two components, PQ, and the other component is P prime Q plus Q. Now, you see this PQ is also your average revenue. Okay. So if I replace the average revenue here by PQ, what I get? I get MR is equal to AR. Now I have replaced PQ by average revenue. So MR is equal to AR plus P prime Q plus Q. Okay. So this is the relationship between the marginal revenue and average revenue. Now in case of a perfectly competitive market, what we had, we saw that the marginal revenue was equal to the average revenue, which was equal to the price, and everything was being determined from the outside of the market. Here we see that there is a departure or there is a difference between the marginal revenue and the average revenue. Now who is bigger, whether the marginal revenue is higher than the average revenue or the average revenue is higher than the marginal revenue? That is the question. That is actually determined by the sign of this portion. If I look at this P prime Q, what is P prime Q? P prime Q is the derivative of this, the equation of this line with respect to Q. So this is basically telling me the slope of the demand curve or the slope of the, slope of the demand curve or the slope of the average revenue curve. So we see that the slope of the demand curve is negative. So the demand curve is falling. So MR is equal to AR minus some positive number. So I can say that plus some negative number or minus some positive number. So you need to add something to MR in order to get the average revenue. So your marginal revenue is actually lower than your average revenue. So in this diagram, if I have to draw the marginal revenue curve, I cannot say that the average revenue is same as the marginal revenue. It should be different. And this is how we draw the marginal revenue curve. Theoretically, you can prove that they start from the same point. Theoretically, you also can prove that the marginal revenue curve has half the slope of the average revenue curve and it just falls halfway below the average revenue curve and so on. But we are not going into those kind of details here. The only point that we want to make here is that in case of a monopoly, unlike perfectly competitive market structure, the demand curve is not the marginal revenue curve. Okay, the demand curve is not the marginal revenue curve, and demand curve is not also the average revenue curve. So the equality between the price, marginal revenue, and average revenue needs to be re-looked at in case of the behavior of a monopolist. Okay, so similar to perfect competition, the profit maximization for monopolist also would imply maximization of profit, which is total revenue minus total cost. See, the only difference is that the price is defined in a different way. Instead of writing P multiplied by Q for total revenue, what I am writing here is PQ multiplied by Q, because the monopolist has a power, to change the price. So that is why P is a function of Q. Rest of the things are pretty similar. So what does the first order condition say? The first order condition says that I have to put T by TQ equal to 0 because Q is the choice variable here. If I do that, from this term PQ multiplied by Q, I get this particular expression. How I get it, this is explained in the previous slide. You can just go back and check. And so this is what originates, this is what you get here. And if you look the CQ, then you take the derivative of CQ with respect to Q and you get the marginal cost. So what essentially here also you get is for profit maximization, the monopolist has to equate the marginal revenue with marginal cost. So this was same in the case of perfect competition as well. What is different? The marginal revenue is now being defined in a different manner. So this component, this P prime Q multiplied by Q, this particular component of price was not there in the marginal revenue that we calculated for the perfectly competitive market. For perfect competition, MR is always equal to P because that was determined by the market. So we see how the equilibrium looks like in a diagram, and there is a small twist here. So this is the demand curve, as we have said. This is the average revenue, which is equal to PQ. This is perfectly all right, the demand curve. We have also derived that the marginal revenue is actually lower than the average revenue curve, and this is how we have depicted the marginal revenue curve. Then we have imposed the marginal cost curve here. So in order to achieve the profit maximization, the equilibrium takes place at this point where the marginal cost intersects the marginal revenue curve. You remember in case of perfect competition, P was intersecting the marginal cost. So P was marginal revenue, and that was, we were taking the intersection of marginal revenue with marginal cost there as well. Now here, when we are doing this is the equilibrium. So this point E is telling me how much a monopolist should produce. So the monopolist should produce this much, okay, this much of output. Let us call this, I missed the name here, but you can give some Q0 or QM probably. QM is the output that the monopolist should produce given the profit maximization. Now the interesting part is that what should be the price that the monopolist will charge? Will the monopolist charge this much? The answer is no. Why is it no? Because we have already discussed that if you look at the demand curve, for any particular quantity, the consumer is actually willing to pay up to this much. Okay. So what the monopolist will do at point E, the monopolist will determine how much quantity is needed to be produced, and it will continue up to the average revenue curve to determine what is the price to be charged. So the quantity is determined by the intersection of marginal cost and marginal revenue. Once you decide the quantity, you put that quantity in the function of the demand curve, and then you determine what is the price that the monopoly would charge. So this is the difference between the monopolist and the competitive firm. Also, one more thing you can observe, that from this particular equation, if you think about this equation, if I take this P prime Q multiplied by Q to the right hand side, then I am left with PQ minus MC is equal to minus P prime Q multiplied by Q. So this is derived from this particular equation. Okay. If I write it in this way, and then also what I can write, PQ minus MC is equal to minus. So instead of writing P prime Q, I am just writing dP dQ and multiplied by Q. Now let us divide both the sides by P. If I divide both the sides by P, the left hand side becomes PQ minus MC divided by P. Okay. The right hand side will then become minus dP by P divided by dQ by Q. So this Q is actually going up, right? And I am adding the divided by P. So this P, this is the P I am adding this in this side, this one, this P, and this is the P I am adding this side. So both sides is being divided by P. Rest of the things remaining unchanged. If I do that, what does this expression mean? This expression, in fact, the reciprocal of this expression, if I take dQ by Q divided by dP by P, this is actually the elasticity of demand. Remember, we discussed the elasticity of demand, the change in demand, percentage change in demand with 1% change in price. So actually this PQ minus MC divided by P, PQ minus MC divided by P, this is 1 by absolute value of E. Why absolute value? Because the demand curve is negative, dP P divided by P, dQ divided by Q, this itself is going to have a negative value. Okay. Since we are adding one minus sign here, therefore we are saying that this is the absolute value of the elasticity. Now see, the interesting thing is that if the absolute elasticity is low, if the demand elasticity is low, if the price elasticity, or you can say the price elasticity of demand is low, then this 1 minus absolute E, this right hand side, is going to be high. If this is high, it means that the gap between price and marginal cost will be higher. Okay, so lower the value of elasticity, higher will be the gap between price and marginal cost. So lower the elasticity, the monopolist will be in a better position to charge higher price from the consumer. This is quite logical in the sense you think about the product which has less elasticity. So low elasticity of demand means even if the price rises, you do not change your demand that much. These are necessary goods, or you may not have substitute of those commodities. So these are the commodities for which the demand doesn't change much whenever the prices changes. So the consumer doesn't have much flexibility on their part. Okay, and in that case, the monopolists do have a market power to charge a price which is much higher than the marginal cost. So this is what we have written. Therefore, the lower the elasticity of demand, higher will be the power of the monopolist to charge more. So the gap between this marginal cost and this average revenue curve, this will be higher in that case if the elasticity is higher. However, what is most important here is to observe that E gives you the equilibrium where the marginal cost is equal to marginal revenue. The output is being determined. However, to understand what the price is going to be, you have to go up to the demand curve, which is the average revenue curve, and from there you actually decide the price for a monopolistic firm. So let us do a quick exercise which may make our understanding a bit clear. So in this exercise we are saying, suppose the demand function is given by Q is equal to 120 minus 3P. Okay, so this is how the demand function is given. Now we have also discussed that the demand function itself is the average revenue curve. It's also given that the cost function is given by CQ equal to 108 plus 2Q square. So the objective is to find out the price and quantity solution for both the monopolist as well as the perfectly competitive market, and we'll understand where the difference lies. So we start with the monopolist. For the monopolist, this is the demand curve, Q equal to 120 minus 3P. Now if this is the demand curve, we can write it in an inverse way, because see what we are saying that the price is a function of quantity. So that this is what we are trying to do here. We are trying to express price as a function of quantity. Just to changing the sides, what we can write that 3P is equal to 120 minus Q, and therefore P is equal to 120 minus Q by 3. So this gives us P is equal to 40 minus Q by 3. So P equal to 40 minus Q by 3 is the equation of this particular line. Okay. Now let us see what is the, so this is my average revenue. This time also represents, as we have discussed, the maximum willingness to pay of the consumer. The amount that the consumer is willing to pay at max for any quantity is reflected in this demand curve. So the monopolist will charge the price along with this line. Now we have to see where does the profit maximization lead us to. So total revenue, so profit is again total revenue minus total cost. Now what is total revenue? Total revenue is P multiplied by Q, but this P is a function of Q itself. So we plug this value of P from here to here in order to derive the total revenue. So the total revenue that we have here is 120 minus Q divided by 3, the whole thing multiplied by Q. So this is the total revenue that the monopolist is earning. Now if this is the total revenue, 120 minus Q multiplied by Q divided by 3, what is the marginal revenue? In order to get the marginal revenue, you have to take the derivative of total revenue with respect to Q. If you take the derivative of total revenue with respect to Q, what you actually get is you are taking the derivative of this particular term in that case, right? This particular term with respect to Q. So see, the first term is actually 120Q divided by 3. Okay. First term is 120q divided by 3 and the second term is q square divided by 3. So if you take the derivative of 120 divided by 3 multiplied by q in terms of q, you are left with 120 by 3 itself. If you are taking the derivative of the second term, then that is q square by 3, what you get is 2q divided by 3. So the marginal revenue will be 40 minus 2q by 3. Now you may recall from the previous slide, if you just go back to the, if I can just go back here, if you look at, right. So if you look at the, the equation for the average revenue curve, see, this is 40 minus q by 3. So this is where 40 is. This is the intercept, 40 minus q by 3. So the slope is minus 1/3 and the intercept is 40. If you look at the marginal revenue curve, here you see that the slope remains 40. So this again justifies why the marginal revenue curve will also start from this point. And if you look at the slope of the marginal revenue curve, this is actually, if you take the negative away, it's double the slope of the absolute slope of marginal revenue is just double the slope of the average revenue curve. So what is happening here? You are actually getting 2 by 3. So that again justifies why your marginal revenue curve should start from the same point as average revenue, and the slope is, it lies just halfway below of the average revenue curve. So this is a typical construction of the average revenue and the marginal revenue curve. So now we have got our average revenue curve, we have got our marginal revenue curve, we have got our demand curve, we know what the total revenue is. What are we left with? We have to understand what is the structure of the marginal cost curve. The cost curve is given by 108 plus 2q square. If this is the cost curve, then in order to get the marginal cost, I have to take a derivative of this cost curve with respect to q. What do I get? There is nothing against 108. For 2q square, I get 4q. Okay. So the marginal cost is basically a straight line originating from this point 0, right? So let us add the marginal cost curve here. So by construction, it seems that my marginal cost curve will not reach 0, but ideally it should have been so, right? The slope should have been such that it starts from 0. Now these are the information that is given to me. Now what I have to do in order to go for profit maximization, I have to equate the marginal revenue with marginal cost. So if I equate marginal revenue with marginal cost, what I get, I have to equate 40 minus 2q by 3. So this is 40 minus 2q by 3, this part, 40 minus 2q by 3, MR should be equal to MC, which is equal to 4q. So this is where I'm getting the MC. Okay. So I'm equating the MR with MC. So if this equation is satisfied, then I have to solve 40 minus 2q divided by 3 is equal to 4q, and this gives me the solution at this particular point E. So this is where the marginal cost and marginal revenue intersects, and this is where I am getting the solution for Q, which is 8.57. So if I equate marginal cost with marginal revenue, once again, what I get is the quantity that the monopolist is going to supply in the market. So 8.57 is the quantity. Now the question is, what is the price that the monopolist is going to charge? In order to do that, what I need to do, I need to pick this output 8.57, put it in the average revenue curve and understand what is the price. Okay. So what was my average revenue curve? If we just go back, or we know it from here, the average revenue curve was actually 40 minus Q by 3, if you remember. So I am going to put Q is equal to 8.57 in 40 minus Q by 3 in that equation to get the price. And that will give me a price which is PM is equal to 37.14. So this is the value that I am getting. This is where I am getting the equilibrium price, and this equilibrium price is PM is equal to 37.14. So what is the profit that the monopolist is earning? You can easily calculate that this is the total revenue minus total cost, which is equal to 63.40. So this is how we calculate we show the equilibrium of a monopolist. Okay. So the reminder is that do not, you equate marginal cost to marginal revenue in order to obtain the quantity. However, the same, equating these two does not give you the solution for the price. For that, you have to pick this quantity, put it in the average revenue curve, and then decide what is the PM, what is the price that the monopolists are charging. Let us see what happens in case of the perfectly competitive market outcome. So this is what now we are showing for the monopolist. So I have actually made this MR line thinner, because for the perfectly competitive market, average revenue itself is the marginal revenue. Okay. So in case of perfect competitive market, what happens? MR is equal to P, which is 120 minus Q by 3. This is again given because P is given. So we know this is the marginal revenue. So you see that the average revenue curve itself is the marginal revenue curve. Profit maximization requires equating this marginal revenue with marginal cost, which is equal to 4Q. So if you equate 120 minus Q by 3 with 4Q, you get the solution at 9.23. So now instead of talking about point E, what we are talking is about point F. This is point F, where the marginal cost curve actually intersects the marginal revenue curve for the perfectly competitive market, which is also the average revenue curve for the perfectly competitive market. So the equilibrium for perfect competition is obtained at point F. Okay. So this is the quantity that the perfectly competitive market will produce. Now this perfect competitive market, it has no way to manipulate the price. So it will actually charge the price where it is determined, the market outcome is determined. And what you can do is that you can take this value 9.23, put it here, 120 minus 9.23 divided by 3, and you will get this price 36.92. Now what is interesting here to observe, and also, okay, you can also calculate the profit as total revenue minus total cost. Now what is interesting here to observe is that if you compare the equilibrium or market outcome under monopolist as compared to perfect competition, what you see that under perfectly competitive market structure, one tends to produce and supply more and charge less amount of money, right? So the price is lower and the quantity produced and supplied is higher in case of a perfectly competitive market structure. However, you can also see, if you compare the total profit that is earned, you will also see that the profit earned by the monopolist is higher as compared to the perfectly competitive outcome. So these are the features, these are the differences between the monopolist and the perfectly competitive outcome. Now, why is it so important to understand these distinctions in the context of understanding the energy market? The problem lies in the fact that if you talk about energy market, and if you can establish that energy market resembles monopolistic market structure more as compared to the perfectly competitive market structure, then you will see that the producers of the energy, they will tend to supply less in the market, create some sort of an artificial scarcity in the market, and will be able to charge a higher price. Now, energy is a component of day-to-day life. It is required for everyday life. It is required for all kind of activities. It ensures the security of the energy. You can't do anything without the energy. So if the market structure resembles the monopolistic market structure, and there is a tendency of reduction in energy supply and charge a higher price, there is a scope for the government in order to intervene and correct this kind of market outcomes. So correction of these market outcomes in the context of energy market is very, very crucial. You remember in the previous lecture we were talking about the regulation, how the price correction takes place in case of electricity. So this is where the government and the regulation comes into the place. There are two corollaries which are very important to discuss, that unlike perfectly competitive market structure, it's not mandatory for the monopolist to charge the same price to everybody. They can charge two different prices to two different people depending on how much they are willing to pay. How does it happen? See, this is the typical monopolistic outcome that we can see here. So what we show here is that the marginal cost intersects with the marginal revenue at point E. Therefore, the monopolist produces at Q star and the price charged is actually P star. Okay. Now, if this is the case, then what is happening? Then what the monopolist actually thinks, I mean, the calculation that goes on in the mind of monopolist, we said that this demand curve, which is the average revenue curve, represents the highest amount of money that an individual is willing to pay for a specific quantity. Okay. So what the monopolist is thinking is that, okay, I'm producing and supplying Q star amount of product in the market and I'm charging P star amount of money. So Q star means I'm actually producing and supplying in the market OQ star amount of product. Now see, for this OQ star amount of product, there are people who are willing to pay higher than this P star. There are some people who are willing to pay higher than the price P star. So instead of charging P star, even if I charge them higher than that, they will buy this product. So what the monopolist can do, they can make two price slabs. These two price slab, one P double star and the other is P star. What is it doing? It's actually dividing the entire output that it is supplying in the market in two parts. So OQ double star amount of output will be supplied in the market at the price P double star. So all these people who are willing to pay more than P double star, they will buy this OQ double star amount of product in the market. However, for the rest of the people, that is for this Q double star Q star amount of product, the price that is set is at P star. So the monopolist, depending on how much the consumer is willing to pay, if that information is there with the monopolist, if the monopolist knows the demand curve, then they can charge differential prices from different consumers. So that is possible, and this is called the price discrimination under monopoly. So again, in the energy market, if you see that it resembles the structure of monopoly, it's possible that different categories of people, different categories of income groups are charged differently for the same energy output. That is possible. So you can The second thing, just to finish this, you see how the profit of the monopolist changes when the price discrimination takes place. See, the cost remains unchanged. I mean, there is no change in the cost if you are charging two different prices from two different communities or from two different groups of consumers. In the first case, if there is no price discrimination, what is the total revenue? The total revenue that the monopolist will earn under no price discrimination is captured by this yellow block. The moment this monopolist has gone for price discrimination, in addition to this area, it will also earn the revenue which is equivalent to this area. So the revenue of the monopolist will actually increase if there is price discrimination. This also means that, it's not necessary that you charge two prices. You can charge, multiple prices. As you increase the number of slabs and as you implement more number of slabs, it's possible for the monopolist to increase the revenue, total revenue, and therefore total profit. But there is a problem with regard to that. It actually, if you go to the economic theory, you will see that this kind of extraction of surplus, increase in revenue, it's actually the extraction of consumer surplus. So the monopolist is being benefited. However, the benefit is being reduced on the part of the consumer. So consumer benefit or the consumer's surplus is being actually transferred to the producer surplus. So this is not always economic efficient, or in a normative manner, this is not something which is always argued in favor of. The last point that we have to make in the context of monopolist is that it's not always the case that the monopolist will earn a supernormal profit, although they can charge a price which is higher than the marginal revenue, or higher than the marginal cost. Why is it the case? You think about the first scenario. So this is the case: you have the equilibrium, you have the quantity supplied by the monopolist, you have the P star, and you have the average cost curve, which is relatively low. If the average cost curve is low, then you see what is the total cost of your production. The total cost of your production will be captured by this area, AC star multiplied by Q star. This is the total cost of your production. What is the total revenue? The total revenue will be, of course, P star minus Q star. So this means this particular monopolistic firm, it earns a supernormal profit because the price exceeds the average cost. However, that may not always be the case. There can be a situation where the average cost is so high that the monopolist, even after charging higher than the marginal revenue, will be unable to recover the cost of production. You take this case. Here the monopolist is doing the same, producing at Q star, charging a price P star. However, the average cost is very, very high. As compared to AC1, AC2 is much higher, and therefore what you see the price is lower than the average cost. If the price is lower than the average cost, then this is the loss that the monopolist is actually incurring. Now this is a situation, this is a classic kind of situation where again you see the role of the government. So if there are energy projects, and usually the energy projects will actually show a very high average cost, and if that is the case, there is a high possibility that there will be a loss in spite of being in a monopolist. So in that case, the government comes forward and takes up the energy project. So this is one line of intervention from the government. What happens? I mean, we have already discussed that the natural monopoly, given the nature of the investment in the energy project, there is a tendency of achieving a natural monopoly because your fixed cost is too high, your variable cost is relatively much less as compared to the fixed cost, and so on. Now, if that is the case, then does marginal cost pricing really is really helpful? Will that really be the optimum solution or not? The answer is no. If there is a natural monopoly, the marginal cost pricing does not lead to efficiency. The monopolist will actually incur some cost if there is marginal cost pricing. How does that happen? So this is the case where you have natural monopoly. So you remember, in case of natural monopoly, the average fixed cost was so high that the average cost keeps on declining and the marginal cost is lower than the average cost. Now, if this is the situation, and if this is the demand curve, and if you want to go by the marginal cost pricing, then the equilibrium will be at E. Okay, we decide that the equilibrium is at E, where the marginal revenue curve actually intersects the marginal cost curve, and then we say that the production should be at Q star. But the problem is, if the production is at Q star your marginal cost is falling below your average cost. Okay, this actually means that at Q star, if you charge P star amount of, if the price that you charge is P star from the natural monopolist, then your average cost is exceeding your P star and therefore you are incurring a loss. So in case of natural monopoly, the marginal cost pricing will always trigger a loss for the monopolist, and the monopolist will not be able to sustain. In that case, the question becomes, where does the remedy lie? Okay, the remedy lies in the two-part tariff. So this is a common tariff structure in case of energy, especially in case of electricity supply. So what is the two-part tariff? This says that the tariff will have two parts. One is the marginal cost pricing. So you recover the marginal cost. That is one part of it. And there will be a second part added to the tariff, which will gradually recover the average cost over the marginal cost. Okay, so this one is that this P star will be charged, but we'll charge something more than P star so that this loss is also recovered over time. So this is called a two-part tariff, and actually we all are very familiar with two-part tariff. I'll just give you the example that you will be able to connect. However, the question that remains, that, okay, we understand that there is a loss here, but how are you going to distribute the burden of this loss to the consumer? Are you going to charge everybody the same amount of money as some additional amount added to P-star, or are you going to distribute in a different manner? So this is a very major question in case of burden sharing. Now you think about electricity. In case of electricity, if everybody has to pay a certain fixed cost, then for some people who are very low-end consumers of electricity, who are using only few units of electricity, it will be too burdensome for them. So the alternative that is suggested, that you custom design the fixed fee. You charge everybody the marginal cost, but the fixed fee should be custom designed. In India, what do we do? In India, we do it in this way. Okay. So we have taken this is the electricity tariff in Chandigarh. I've taken, this is the recent tariff. So see, there are slabs. So if your electricity consumption is from 1 to 150, then you per unit you pay 2.75 rupees. If it is between 151 and 400, you pay 4.8 rupees per unit. And if it is above 400 units per month, then you pay 5.2 rupees per unit. Now see, if you look at the production, marginal cost of production, in the previous case of national monopoly, you will see that the marginal cost of production is actually falling. So there is no justification. If you base your pricing on the marginal cost, there is no justification why should you charge more at the higher slabs. But this is happening because you are trying to distribute this loss in the form of a fixed charge which is being collected from the consumers. And this gives this kind of a tariff structure. Okay. So the other thing is that when there is a natural monopoly and you try to work out a tariff structure which is not a typical P equal to MC tariff structure, you really don't know how the private entities are going to work with. So especially in 80s and early 90s, you see especially in 80s, I mean, there's a lot of the public ownership that went around in the context of energy industry. So energy industry was highly public investment heavy, and there was a lot of public investment that was going on so that the government can control the tariff structure. However, if you look at this tariff, this is called a two-part tariff. So one part, as I said, is to recover the marginal cost, and the other part to recover the loss. And this is how the tariff structure looks like. These are the thresholds, 150 and 400. So up to 150, it's like this. This is the tariff that you charge. Then the tariff goes up, and then the tariff goes up like this. So here what I have made is that I have to, in order to make it continuous, I have kept it like this. But ideally it should be a sort of a step kind of diagram. So we are going to close our discussion here by saying that what we have observed so far is that the nature of energy market is more closely associated with the structure of a monopolist, which actually restricts the outcome of the market. It reduces the outcome of the market and tends to charge a higher price. And therefore, we all have also seen that in case of natural monopoly, there will not be a scope where the price equal to marginal cost pricing can be applied for, and new innovative price mechanisms are applied in those kind of situations. In future lectures, we will also talk about the oil market, and we'll see how the oligopolistic market actually is at the core of this oil market, the world oil market. Thank you.